Hi everyone, I'm America Josh, and welcome to Investing and Growing Wealth as an Australian expat. Growing wealth in Australia as an Australian expat in the US. Every month, we're bringing to you different webinars about different topics that help you both personally, professionally, just in life to make things a little bit easier for those of you who do live abroad and live in the US or might be planning to move to the US. I know that a lot of the registrants for tonight are people that are thinking about coming to the US at some point in the future. And they're planning, timelines. They're working out what good strategies they might have. So tonight is a great opportunity to connect with some awesome professionals and really get an idea for what's possible when it comes to growing wealth in Australia when you do move. So first things first, though, I want to get some of the important stuff out of the way because we want to make sure we do everything right. We do have a general advice disclaimer to read tonight. So the information in this presentation does not constitute financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. Apt Wealth Partners, Murphy Tax, Uptrend Advisory, and America Josh recommend that you obtain professional advice before making any decision in relation to your particular requirements or circumstances. So, lots of words just to make sure that you know that tonight we're talking big picture. We're talking 30,000 feet. We know we had a lot of questions that were quite detailed, and we've tried to broaden them out to make them applicable to as many people as possible. So by doing that, what we've done is we've divided tonight up into a few different sectors. They include residency, investment, property, retirement, inheritance, and tax. All of these topics are crucially important to growing your wealth and investment strategies and thinking about how to grow your wealth in Australia as an expat abroad. And each of our panelists, who I'm going to introduce in 1 second, bring a different aspect of information and a different expertise into each of those categories. So we're going to make this a bit of a discussion, make this a bit of a round table where we can throw questions back and forth. I'm thankfully for everyone watching, not going to be answering the questions. I'm going to be asking most of them of these professionals. But yeah, if you do have questions, you should see that there's a questions option or a Q&A button down the bottom. If you do have questions or if you want to follow up, feel free to include your question at any time, and we're happy to answer that as we go along. But to jump right into it, I want to introduce John Versace from Apt Wealth. John is the head of expat services and a senior financial advisor at Apt Wealth. So he's our expert tonight on investment and growing wealth in Australia as an expat abroad. G'day, John.
Hey, Josh. Good to join you.
Thanks a lot. Brad Murphy from Murphy Tax. Brad is a director at Murphy Tax with a huge amount of information, huge amount of international tax experience. So is our expert for Australians living abroad and their international tax obligations from Australia. G'day, Brad.
Hey, Josh. Thanks for having me on board tonight.
No, thank you. And Jason Stoch from Uptrend Advisory. Jason is the owner of Uptrend Advisory and is our resident tax expert for all things US tax. Right now, Jason is in the thick of US tax season, so we thank him very much for joining us tonight. G'day, Jason.
G'day, Josh. Thanks for having me.
Awesome. So we're going to go through these topics, and we've got a whole bunch of questions. You've submitted all sorts of questions on all sorts of different things. So we're going to do our best to answer as many of them as possible in the hour. And at the end, we're going to outline some of the ideas for, action items that you can actually go do, things that you can think about as your next step, and also any mistakes that our panelists have seen commonly occur, because we know that some people are looking for, what to look out for, what traps to avoid. So without further ado, I want to jump right in. So John, I'm going to jump to you first. I thought a good space to start would be around residency and citizenship residency, where you exist, where you are right now, where you're going to be, what your plan is, because I know that's going to become a lot of the conversation that we have tonight is around where you are or where you're going. So do you want to start by introducing sort of the concept of residency and where it's important around investment, and also a little bit of an intro about yourself and Apt Wealth, please?
Yeah, no worries. Thanks, Josh. Firstly, introduce Apt Wealth Partners. So we're an Australian financial advice firm. So we've got our main offices in the Melbourne and Sydney CBD. So been around for about 30 years. We have about 80 employees, look after close to $3 billion in wealth on behalf of our clients in portfolios that we directly manage with the support of our internal investment team. But we have a specialist team that I head up that looks after cross-border situations, and a very large component of that cross-border clientele are US citizens living in Australia and Australians living in the US. But like many of you tuning into the call today, so that there are just very specific financial considerations that you obviously have that we're going to go through today that require that specialist knowledge on how issues are handled across borders. So that's something that we specialise in. So getting to the topic that you mentioned about residency, that has a huge huge bearing on how you're going to be taxed, where you should be building your finances. Yeah. So most of you that are tuning in, we're going to assume that you're a resident of the US and you're there for a reasonable length of time, more than a couple of years, and you're likely to be a tax resident of the US and also a non-resident for Australian tax purposes. And I'm sure Brad and Jason are going to go through that and how that works in a little bit more detail. But assuming that's the case, then the way that you're going to be taxed on your income and assets is going to change from when you were living in Australia. So the US is going to be looking at your worldwide assets and taxing you on your worldwide income if you're a tax resident of the US. Australia is going to be taxing you on, just Australian real property and, any businesses in Australia, for example. But the way that certain assets in Australia are treated and worldwide are going to vary dramatically. And then the way the US is going to tax your assets outside of the US is quite complex as well. So it's a very much a changing landscape for you financially from when you were living in Australia, and the financial considerations will change quite a lot, which we're going to get into in a lot of detail in the session today. Yeah. So
no, I love it.
And I guess just summing up, the location of where you're going to be longer term is super important as well. Where you're actually going to be using those assets. So we'll go into that later in the session as well.
Yeah, no, and I think that's an important thing to call out earlier, is that it's great that people are tuning in because it is important to plan. And even if you don't necessarily know exactly what your plan is, at least having an idea of, some of the options is going to be important. Jason from Uptrend Advisory, thank you again for joining us. I know residency is a big issue in the US, especially, and I know John sort of touched on this, but is there anything else you wanted to add? I know we've talked before about tax and how important residency is. Are there any things that you want to sort of add in terms of what you see regularly for Australian expats?
Yeah, definitely. And John covered everything really well at like a very high level. On the US side, there are specific tests that can be applied to determine whether you are or are not a US tax resident. And it's very important that you know about these things before accidentally triggering it and then being in a situation where suddenly everything's on the table, whereas you had some timing opportunities to clean things up. The main one, is the substantial presence test, which most Australians that are in the US are subject to based on, the E3 visa being the most popular one. So if in a calendar year you pass that substantial presence test, which is 183 days of physical presence in the US, you are a US tax resident. If you're under that threshold, you're not. And that determines and drives your reporting obligations. So if you're not a resident, you get to avoid disclosing what you have in Australia, which keeps them safe. But if you are a US tax resident, then everything's on the table. And that's where it's really important to make sure you're structured in the right way to avoid pitfalls.
No, fantastic. Brad, so if someone is potentially going to make the move back to Australia, if they're living abroad and they've got some wealth that they're building up, on this sort of topic of changing that position, what do people need to keep in mind? What happens when you decide to return if you've built some wealth?
Yeah, good question, Josh. I guess like in a nutshell, it's quite easy to keep US investments for Australians coming back to Australia, and the outcome is normally quite favorable for Aussies coming back to Australia in particular. So Australians have been in America on an E3 visa, L1 visa. For those Aussies coming back to Australia, the outcomes are usually quite beneficial in that their US assets get rebased to market value for Australian purposes when they come back to Australia. So US, property, US mutual funds, US stock, all get rebased to market value when they come back to Australia. And in a similar fashion with their 401k or IRA, that can normally be managed quite effectively for Australians when they come back to Australia. I guess for US citizens, that's where it's a little more tricky and very important to manage that a bit more strictly, and Jason can no doubt chime in as well. But normally it's more difficult for US citizens or green card holders to put money into Australian super or to invest via, you know, Australian family trust, or to make certain investments in Australia. So in that regard, we normally recommend, you know, putting Australian assets normally in a non-US person's name, you know, assuming the couple are happy to do that, of course. But I think it's just important to have a real short, medium, and long-term roadmap when you do come back to Australia. You know, what are your short-term goals, medium goals, and long-term goals as it relates to Australia and the US tax system? But yeah, I'm sure Jason will chime in with some more detail in a moment.
Go for it,
Yeah.
Jason. Yeah.
Yeah. I mean, definitely, like, having US citizenship while you're in Australia does kind of shackle you into what you can do without causing negative consequences on the US side, because the substantial presence test I just talked about, that doesn't apply to US citizens. You're always a US tax resident, no matter where you're living in the world. So, as Brad talked about with trusts and things like that, which are great for Australian tax planning purposes, not really on the US side. And then John can also talk to things like investments, like PFIX, and it's just a minefield as a US citizen living abroad.
Okay, and that counts, just because I know that we will have some people that counts for people who have green cards as well. So that, like, if because you're a permanent resident, so you are
exact same category, green card, US citizen, you're still always a US tax resident.
Okay, so again, good to think about for planning. If you're saying, you've got the option to get a green card, if that's lovely, but if you're planning to move back to Australia, that is something you do want to flag with your, financial professionals, like the people we've got here tonight. John, are there any, for expats in particular, for Australian expats who are living abroad or planning to live abroad, are there things that they should avoid when it comes to investments, or like asset classes, things that they should be thinking about?
Yeah, definitely. There are. So, from again, looking at it from the perspective of an Australian living in the US, non-resident for Australian taxes, and a permanent resident of the US, and obviously subject to US taxes. So property in Australia, I'm not saying to avoid it, but you are taxed a bit more harshly from the Australian tax side of things. So that's something just to bear in mind and consider. And I guess it depends on the length of time that you're going to be overseas. And by all means, absolutely be very careful of selling your former primary residence. So that's just something I always throw in there, because it's a horrible outcome if people are doing that whilst they're non-residents for Australian taxes. Shares and managed funds can be treated much more favourably from an Australian tax perspective, but you've got to be very careful how the US will treat any assets that are domiciled outside of the US. So anything that is indirect, so managed funds, ETFs, property trusts, anything that's not a very direct company stock outside of the US is really problematic from a US tax standpoint. Jason mentioned the term PFIC, or passive foreign investment company. The tax outcomes of those are horrendous. The extra tax that you've got to pay, and the amount of filing Jason would have to do in that scenario is usually not worth it. You can do what you like in the US, in terms of any managed funds, ETFs, but anything domiciled outside of the US. And then the other thing you've got to be careful of is that, as Brad, I think, alluded to a little bit earlier, is that there are some tax advantage structures that make sense in one country but may not make sense in the other jurisdiction. So to throw out a few examples there's things like Roth IRAs and 529 plans that are quite popular in the US, that if you come back to Australia and start to utilise those assets, they're not going to be treated in the same favourable way as what they are intended to in the US, and vice versa. So, we'll get into things like superannuation and those types of assets in Australia, which are great tax advantaged structures in Australia, but don't quite mesh with the US jurisdiction. So, got to be careful of certain tax structures. They're the main things to watch for.
Yeah. Okay. So it really is like understanding that what works in one country, and I realize it's sort of simplifying a lot, but what works in one country doesn't necessarily work in the other country. That's sort of the fundamental thing, is that while it might make lots and lots of sense to have it set up in a particular way, it does not make sense if you're planning to move between two countries.
Yeah, 100%. And some things are not, complete disasters, but you may not get the exact tax outcome that you were intending.
Yep.
So be very careful. Setting up these tax advantage structures in the US, and seek guidance before you do it. And it may not be a complete disaster, but just make sure you know what you're getting into, and what the end outcome is going to be if you're going to be back in Australia.
Yeah. Brad, did you want to add to anything about the investments or asset classes that people should be avoiding?
Yeah, I mean, just to echo Jason and John's comments there, I'd certainly agree. For Aussies in America, really important to avoid putting money into Australian super while they're in America. There's definitely some upside to waiting to Australians coming back to Australia to put money into super, because you can utilize a 5-year catch-up of your Australian super. So you can actually put in your $30,000 pre-tax cap. You can times that by 5. So potentially putting in up to $130,000 into your super pre-tax when you come back to Australia to lower your Australian taxes and get money into the super environment. Really, really effective. Secondly, avoid those PFIC issues. So avoid investing in the Australian mutual funds or ETFs while you're in America. And as I mentioned before, the real upshot is if you're buying US stocks or US shares, when you come back to Australia, they get reset to market value when you come back to Australia. So it can effectively almost sort of quarantine this capital gain you've made while you're in America, if you're an Aussie in America, and get a bit of a free kick there on the US stock side when you hold those investments and come back to Australia. I think Australian property is also a big one, which we're going to talk about in a moment. So I'll leave that for the time being. But as John mentioned, give some thought to setting up a family trust as well when you come back to Australia. Normally, that's very effective for couples coming back to Australia to utilize a family trust once you're back in the country.
There's been a question just in terms of ETFs. So if you had ETFs in Australia and then moved over to the US, it's still going to be the same treatment that we're talking about. So unfortunately, the US is essentially going to tax that as a PFIC, even if you held it before, or you bought it before you moved to the US. So that's something that for those planning to go to the US, look at what your Australian assets are and plan for how the US is going to treat it when you get over there.
No, fantastic. And sorry, just to answer one other question that just came in, we are recording this whole webinar, so there's going to be lots of things that I know people are going to say, can I just hear that again? We're going to repeat some of the things that we talk about to make sure that it's really clear, but we've also got a full recording that you'll be sending out at the end of the webinar, so no issues there. Jason, just on trusts, I know that was mentioned, something that when you're potentially going back, is there anything you want to mention for people who might be thinking about that strategy, or if they have trusts, if they're coming to the US as an Australian?
Yeah, I mean, from an Australian perspective, it's just making sure that, the trustees and beneficiaries, ideally you're pointing that stuff away from the person that's going to become a US tax resident. Because if you have a trust where you're a trustee, you own a foreign trust, and then the IRS wants to know about what's happening within that trust. So it just comes back to making sure that, your structure is, as efficient as possible for Australian tax purposes, but also ring-fenced if possible for US tax purposes. There are trusts and things like that in the US, but they're not quite the same as Australia when it comes to all the tax efficiencies. They're not as good.
Okay, good to know. John, in terms of owning stock or owning sort of assets in the US, if you do invest while you are in the US and you've got like an E-Trade account or some sort of account that manages your funds, when you move back to Australia, what sort of is the process? Do you have to sell all of that? Do you have to get out of that account, or what's sort of the general process there?
Yeah, no, you can keep it. There's no legislation as such that says you have to cash out the minute you leave the US or anything like that. It all comes down to individual policies on different brokerage houses and whether they're actually going to allow you to have the account and trade on the account whilst you are back overseas or back in Australia. There's some that are much more receptive than others to holding those brokerage accounts, and it's worth doing some research into those and making sure that when you come home, can you still operate the account from home, or are they going to put some roadblocks in terms of you trading or buying and selling whilst you're back in Australia. So it just comes down to individual policies, and some of you that moved from Australia will know places like CommSec will have very similar policies from an Australian side of things. It comes down to the individual brokerage houses.
Okay. And Brad, do you have anything to add around, like, if people wanted to invest in Australia, like, are there risks involved with holding assets in each different country about getting, I know we had a question about them getting stuck in a particular location, for example.
Yeah, it's a good question. And it's probably more, as John mentioned, more of a financial question in terms of what the broker or banks are doing. And certainly, yeah, Australian brokers like, CommSec, NAB do make it more difficult for non-residents to trade on those accounts if you tell them that you're living overseas. So I think just be mindful of that. If you've got an Australian share account, just be mindful that if you do go non-resident and live in America, the broker may suspend that account. But it does depend on the broker and the bank in particular. I think in terms of the other question as well, look, you can certainly move cash between the two countries relatively easily from a tax point of view as well. This whole $10,000 sort of myth, right, is not actually
it comes
really
up all the
true.
time, Brad. It's constant. It's
yeah. I mean, obviously you've got $10,000 of cash on a plane. You got to declare that to customs when you come into the country. But no, normally from a tax point of view, you can transfer money between the two countries with no tax, assuming it's post-tax money. But just be aware there are some foreign currency rules, tax rules in play. If you've got significant cash, just say you're in Australia and you hold more than 250,000 US dollars, appreciate that's a lot of money, and most people, probably not lucky enough to have that sort of cash. But just be aware if you do hold significant US dollars, then there can be some foreign exchange tax rules in Australia to be mindful of.
Okay, good to know. And Jason, this one's a good one for you because it relates to exactly what we were just talking about before around like residency and positions. Someone's asked, if you hold a US green card, can't you just give it up and when you move back to Oz, and then therefore you're not a US tax resident anymore? Do you just want to touch on quickly what the implications of giving up, or sort of, is that as easy as that?
It can be, but it also can't be. So it really depends on how long you've held the green card for, because green cards do have this concept of an exit tax, where if you've held a green card for 8 calendar years, you could be subject to an exit tax test. And then, there's a few prongs in the test, which are, based on your net worldwide assets, based on your average tax liabilities, and also if you've been compliant with all of your tax filing obligations to date, which can trip a lot of people up. So
no, it's not. Can be, yeah.
It can be, like, if you've held it for 1 year and you've given it up kind of thing, but for most long-term holders, it's more complex.
Yeah, got it. All right, John. So we talked about investing in sort of it can be moved. What is, and I understand, again, we're not talking individual advice, but what do you generally say to someone who might be in Australia or might be in the US right now and they're thinking about moving back? Do you normally sort of say, like, invest in Australia because you're going back, or is investing in the US sort of depends on the individual's sort of situation? What's the sort of go-to there?
Yeah, it does depend. And some of you, we've been talking about PFIC and those issues that investing in Australia can have, and you don't have those issues in the US. You've got a much broader range of assets that you can purchase in the US. So many of you be thinking, why on earth would you invest in Australia? It really comes down to currency exchange risk ultimately, and managing that, which is a huge element to all this. Obviously, you've got taxes that are a huge consideration, but currency exchange risk is super important as well to think about. So, in the example that you're an Aussie living in the US, and building all this wealth through employment income and you're selling some vested shares and working out what to do with it. Your longer term plans are back in Australia, retirement, kids' private school are going to be back in Australia, and that's sort of a 5-year time horizon. If you're looking at currency exchange at the moment, and you're kind of going, it's quite favorable judging by historical levels, to be sending money back from the US to Australia right now. Who knows what it's going to be in 5 years' time? Could be better or worse, but I guess that currency exchange risk is a huge element of your end financial goals. So there are things you can do in Australia. So very direct stock portfolios are things that you can do. So not advising to invest in these specific shares, but as an example, Commonwealth Bank, Telstra shares, those sorts of investments you can invest in, and they typically won't be a problem from a US perspective. So that's, I guess, an element of why you would say, okay, maybe I will send, and it doesn't have to be an all or nothing proposition. You could look at, because really the US market is, really everyone should have some exposure to the US market. It's incredible. The best companies in the world are domiciled in the US, in my opinion, many people's opinion. We don't have the same companies in Australia, although we've got some great companies. But also just making sure that it's certainly not all about just getting the absolute best investment. You've got to look at tax, and you've got to look at currency exchange risk, and making sure that you navigate those issues as well. So that I guess if it is a shorter term move, you're coming back within 5 years, there is consideration of going, okay, let's send money across to Australia, average out the currency over a period of time, and manage that risk. But if it's going to be 15 years that you're going to be in the US, and especially if it's a smaller portfolio, it's much harder to invest smaller portfolios when you can just invest in just direct company stock. Then it's probably better to stay in the US.
Yep, got it. Brad, we've mentioned PFIC a couple of times. Can you box up PFIC I know some people might be saying, some people, me, like, can you clarify PFIC a little bit, like give us a little insight into it?
Yeah, well, PFIC's very much a US term, so I might let Jason perhaps elaborate on that one, and I'll jump in afterwards.
Yeah, it's, in short, it's a very punitive form of IRS taxation where they are targeting non-US domiciled mutual funds, index funds, ETFs, REITs, listed companies that are managed funds, anything that's kind of in a passive bucket, they will give it that designation, passive foreign investment company, or PFIC for short. It triggers potential taxation on unrealized gains. So, if your Vanguard grew from 10 grand to 20 grand, there is a world in which case the IRS says, oh, you made 10 grand. Great. Thank you. But the ATO wouldn't see that because you haven't crystallized it. You haven't sold. So, that is what a PFIC is, and it's quite nasty. And if you can avoid it, you should avoid it.
And just to expand on that point, Josh and Jason, Australia has not got those same punitive rules in Australia. So the ATO certainly does not mind if you hold US investments from Australia. So there's no PFIC in reverse for Australians holding US shares or stocks. So certainly once you're in Australia, you can certainly hold your US share portfolios, and there's no issues there with the ATO.
Love it. All right, we've talked a little bit about investments, and I'm sure we'll keep touching on topics around assets and things, but one of the big assets that people have sent in a lot of questions about is around property. So Brad, I wanted to give you a chance to jump in about sort of the like what options are available to people if they're looking to invest in property. What should they be thinking about?
Yeah, thanks, Josh. Obviously, property is a huge topic, right? We could probably spend the whole hour just talking about property, but I think it's really important to obviously get some proper advice regarding property on both sides in Australia and the US. But as a normal rule, Australians moving to the US holding Australian property do face a higher tax burden than what they would if they're living in Australia. And I think that the biggest key factor is going to be your Australian main home. So normally, if you live in Australia, you live in your main home, you sell it, it's free from tax under the main residence exemption. Now, the ATO changed this law about 4 years ago to say that if you're not tax resident of Australia, so you live in America, you sell your Aussie former main home, you're going to pay full tax, right, on that gain, which is a disaster. So you'd never plan on doing that, of course. Now, you've got some options there. You can rent out your Aussie property for 6 years, get the full exemption for that 6-year period, come back to Australia and look to sell it once you've recommenced Australian tax residency, but really plan on trying not to sell your Aussie home from America. The other point would be that the US also has laws regarding primary residence exemptions, which Jason will expand on in a moment. But be aware that if you're, he's not, yeah, he's to jump in. Yeah, but I think just be aware that Australia does exempt the gain in full. But if you're a US citizen owning an Australian property, there are some limitations in America to be mindful of as well.
Jason, do you want to? Sorry, Brad, keep going. No, go for it.
Yeah, no, go ahead. Jason.
Yeah,
Jason.
I mean, unfortunately, the IRS, as the theme of the night is not as generous as the ATO.
Yeah, if the IRS is listening, by the way, I think you're great. So I don't know what these guys are.
There is a cap on selling the primary home. Like, you do get an exemption, but it's capped. So if you have lived in a home for 2 years out of the most recent 5-year window prior to selling, if you're single or married filing separately, you're exempt on $250,000 of capital gains. If you're married filing jointly, it's $500,000 of capital gains. And that, at least it's something, but anything above that amount would then be subject to tax. And that can create a negative situation where the IRS may be taxing you on something the ATO is not, because they're not taxing on the sale of your primary home. So it's just also something to be mindful of. And to make it even worse is, if you're living in a state in the US that has a state income tax, there's potential exposure there as well, because some states don't recognize the tax treaty.
Got it. John, is property something that you see a lot of people, like a lot of Aussies who are living abroad? Is that something that you see a lot of?
We do, yeah. Aussies love their properties, of course. So it is, it's certainly something that many of our clients are looking to, looking to utilize, buying an Aussie property, especially if you're looking to come home. So, and again, it's certainly something that if you're coming home in a couple of years, that tax outcome isn't going to be as bad as someone, buying an Australian property and returning in a couple of years. It's not going to be as bad as someone that buys a property in Australia and it's going to be 10 years before they come home. So the sort of length of time will sort of, dictate, the tax outcome and how bad that will be. So certainly something that, that many of our clients do, but you've just got to be wary of what the end outcome will be when you eventually do sell, and the actual tax on rental income as well. But there are some strategies around how to minimize some of those aspects as well. So that's but it's certainly something a lot of our clients do look at.
Yeah. And does somebody, just so I understand from your perspective, John, does somebody come to you and say, like, here's my open book and I've just got some questions? Like, tell me, is that kind of how people start? They might already live abroad. They might be planning to move. It sort of ranges the full gamut.
It does range, yeah. So typically, it's either people moving abroad or people looking at coming home. There's usually a trigger for people to seek financial advice. You don't have to get financial advice. Like you've got to do your taxes. So people will see people like Jason and Brad just out of need to file taxes every year. But financial advice is usually something that will trigger someone to seek it, and it's when their circumstances get more complex or a milestone like retirement. But often people will come to us and say, I've got this financial situation. What do I do? It's very hard for financial advisors in Australia, unfortunately, because of legislation to do kind of one-off type advice. But we can, obviously look at putting together a strategy and making sure that our clients stay on track and having that ongoing relationship with our clients. And quite often people will come to us and go, "This is my situation. What do I do? What assets do I build? Where do I build those?" And that's where we come into it.
Perfect. And Brad, for people investing in Australia, what entities do you normally see people set up in order to make those investments? Are they doing it themselves, or are they?
Yeah, it's a very good question. Look, I mean, the majority do it themselves, to be frank. I mean, there are some additional compliance and holding costs utilizing a structure like a trust or company. Certainly the most common vehicle in Australia is going to be the family trust, and that can be used to hold, shares, investments, and investment property in Australia. So, I mean, if it's the main home you're looking to buy, that would always go in your personal name to get that main residence exemption, which is not available in a trust or company. However, if it's investment properties, there can be some benefit and certainly merit in looking at a family trust to hold Australian investment properties. The reason being you can distribute the income and gains from that trust to the beneficiaries, at that time. But to Jason's earlier point, just be mindful, if you're living in America with that family trust, there are some additional US compliance obligations to be mindful of. But I think an Australian family trust can definitely help ease some of the tax burden on the Australian investment property side. Because with that backdrop, effectively the net rental profit on an Australian investment property is taxed at 32.5% on the profit to a non-resident, which is quite a high rate of tax, right? So we look to try to mitigate that, as best we can.
Yeah, got it. And Jason, what do you see from people, from Aussies living in the US, if they're investing in the US side of things?
Yeah, so it again comes back to, the person's net wealth and net earnings every year. Like most people will just hold things in their own names in the US. But for people that are at the very, very high end spectrum, there are other things that can be done with like donations and putting them into special donation trusts that you can get personal deductions for, but that's not for the everyday person kind of thing. So for most people, it's unfortunately limited that you're mainly just going to be holding it in your own name.
Got it. And Brad, we had a question around whether you can invest in new developments or old developments. Is that a question that comes up for you? Or something
Yeah,
that you can
yeah,
answer?
most definitely. So I think, yeah. So it's a good question. I think that the context there would be, first of all, for non-Australian citizens and non-Australian permanent residents, there is a foreign stamp duty to be mindful of. So that's something we haven't actually spoken about previously, which is an important point that, if you're not an Australian PR or citizen, you would need FIRB approval to buy an existing home. Doesn't normally apply to new developments. But just be mindful of that. Secondly, there are some concessions on new developments. So there can be concessions with stamp duty and first home buyers grants in the various states. So normally if you're buying a new development in certain states, they offer some concessions with stamp duty or a grant to acquire the new property, which doesn't apply to an existing dwelling.
Got it. Now, John, we had, in terms of like these investments, whether it's as real property or other sort of assets, we had a lot of questions around timing and sort of when people should be investing. And I imagine it's something you get asked quite a lot. When should I buy? When should I start this process? Do you have sort of, is earlier always better, or is it really, again, and I know it depends is going to be an answer. It's a common thread, and that's completely fair. But does it just depend on your personal circumstances about the exact timing, or are there good times of the year, bad times of the year, or parts of your move?
Yeah, it depends. Yeah. So, but not so much, time of the year. It's more so time frame of, when you're going to return back to Australia, and the timing of which asset classes, because property and shares when you're back in Australia, no difference in terms of the actual tax, income tax, capital gains tax outcome, but very different when you're in the US. So there's considerations around that. So if for example, for someone that is looking at having a really diversified asset pool longer term, and you want to have an investment property and a share portfolio longer term, and you want to contribute to your super longer term, then the timing of when you purchase those different asset classes is going to be super important. So in an ideal world, you can buy the shares, being very careful of PFIC while you're in the US, come home, buy the property, contribute to super when you're back home in Australia, and the US isn't as much of a problem, and non-resident Australian taxes aren't as much of a problem. So that if you can navigate things that way, then timing is super important. And it's more so just the tax residency, that's the main consideration there.
Yeah, got it. Brad, there was a couple of questions around negative gearing and tax optimization for investments. Is there anything that people should be or expats should be thinking about, Aussies abroad, about negative gearing?
Yeah, negative gearing obviously very popular in Australia. So that same concept would apply to an Aussie expat living overseas in the US. Those negative gearing benefits still carry forward to their benefit. So if the property makes a loss, so that in a nutshell means that the expenses exceed the income. So really, if the mortgage interest exceeds the rental income, that loss can be carried forward indefinitely. And that loss can be used to offset any future income from the property or employment income when one comes back to Australia. So negative gearing benefits certainly still there for Aussie expats. And the way interest rates have gone lately, with interest rates rising, land tax rates increasing, a lot of properties that were perhaps making a profit have now swung around to a negative geared property, which is becoming more and more common. So certainly still some benefits there for the negative gearing side, for sure.
Yeah, got it.
Yep.
And Jason, do you see any other sort of strategies for investing in the US, like around tax optimization and things that people should be keeping an eye out for as an expat?
Yeah, I mean, owning homes in Australia, like it's just being mindful that, if you're a US tax resident, you've got to disclose it. Negative gearing, it's again one of those ones where it's not as generous in the US. To get the benefits of negative gearing, there are like strict rules that you have to abide by, essentially being like a real estate professional to do that. Otherwise, when it comes to investing in buying multiple rentals and flipping and moving them, like the US tax code actually allows you to defer capital gains through something known as a 1031 exchange. But that's, specifically targeting someone who is wanting to be a real estate developer or investor, as opposed to the kind of everyday man.
Okay, so that particular sort of exception is more specific than most of the people that would be listening. Like, it's something they should explore, but it's not going to sort of just quickly and easily be applied.
Exactly, yeah.
Got it. All right, we've got limited time, so I want to make sure that we get through a few different things. So I'm going to move off property, and if you have some extra questions, be sure to ask them, because I'm sure these lovely, fine panelists will be happy to either answer at the end if we have time, or we will we'll get some information to you. I want to talk about retirement, because 401ks, we touched a little bit, John, I think you mentioned earlier, Roths and IRAs, and we sort of, if you've come from Australia, you know about super, and super is the shining light, and then you come to the US and you get presented with 35 different options and a whole bunch of different things. So John, do you want to give a little bit of an intro to sort of retirement 401ks and the contrast with Australian super?
Yes, sure. So, I mean, essentially, 401ks are essentially set up by your employer, and as the retirement savings vehicle set up by your employer, which, you can essentially, in an Australian term, salary sacrifice and contribute pre-tax into your 401k. Sometimes your employer will match or contribute extra for the contributions that you put in. So essentially, the money goes in before tax into the 401k. It earns tax-free, and then on the drawdown, it's taxable. So that's different to superannuation, where superannuation is really Roth IRA, 401k, and so many elements of the US retirement system, all bundled into one kind of beast. But super goes in tax concessionally, and then taxed at a very low rate along the way, and then comes out tax-free, assuming you don't apply US taxes to superannuation. So from an Australian tax standpoint, so that's where they differ ultimately.
Okay, so is a 401k, like, can people get access to it if you are an Australian and you're living in the US and then you decide to go back? Is that something you can get access to easily? Or I know there are some fees, and we'll talk to Brad about sort of the tax implications, but in terms of sort of strategies around what they should be doing, what do you advise in that space?
Yeah, there's ways you can get it. Brad, I'll leave it to Brad to talk about the tax outcomes. But it's consideration, I guess, of they are good vehicles ultimately. Some Aussies are looking at it going, oh, it's going to be taxed on the way out. That's completely the intention in the US anyway. So it's not, it's been taxed. It's been tax-free going in. It's tax-free on the earnings. You've got to pay tax on things somewhere along the line. I'm sure everyone knows that the tax authorities want their piece at some point. And often that is in, if it's a large 401k, if it's bubbling along tax-free and you draw it out in retirement when presumably you don't have much else in the way of tax, your employment income is out of the way, then it can be a fairly favorable outcome, to still keep your 401k. You can access it early, but yeah, there's likely to be some tax implications of doing that. And, it might be a logistical thing. If you've got 20k in there and you just don't want this painful thing just there in the US, and you're happy to worry a little bit of a tax, fine. But yeah, it's especially larger 401ks, you've got to be a bit careful.
Yeah. No, I know that a lot of people get told about matching and things, Brad. So there's sort of incentive to make these investments. So do you want to talk a bit about the tax strategies around 401ks and retirement?
Yeah, for sure, Josh. I mean, I guess my view is that, free money, free matching programs, it's always good, right? Take it. That's my view. And, you can manage taxes afterwards. But I think a couple of points would be, for people that return to Australia with a 401k or IRA, Australia would not recognize it as a super fund in Australia, unfortunately. But having said that, the tax treatment can be somewhat favorable, if you like, given the tax treaty outcome. Now, in a nutshell, if you were to take a distribution out from your 401k or IRA from Australia, Australia would tax you on the growth component of those funds. So the contributions that have been made by your employer, employer matched or personal contributions would not be taxable in Australia. And the tax treaty would normally allocate taxing rights to Australia under that scenario. Not always the case, but normally would. And that can be quite beneficial. And it's just about planning how to mitigate the Australian taxes from that point. You could put money pre-tax into your Australian super, utilising a concessional contribution. And I guess what we see in practice is a there's really two buckets of people. Some like to take the money out early to, buy a home in Australia, to invest it in Australia, or the other bucket is they keep their retirement fund in America until they're, 59, 60 and keep it as a second retirement fund. And I think both options can work and are quite tax effective, I would say. So I think certainly nothing stopping Aussies coming back to Australia and holding on to their US plans.
Okay. Jason, do you want to quickly and I understand saying quickly summarize, all of US tax code is a tough one, but Roth IRA, we had a few questions around these terms. So 401k, Roth IRA, like these kinds of things. Do you mind explaining some of the breakdown of just how they work in the US?
Yeah, so 401k is the traditional 401k plan that's employer sponsored. You're allowed to salary sacrifice, as John called out, deferring some of your income to that retirement deferred bucket. An IRA is essentially an individual retirement account, which you would set up outside of your employment, and you can contribute that to the limits each year, and then it would operate in the same way as a 401k, where it's tax deferred until you withdraw from it. Roth is different in that it's the reverse. You have paid tax on money, and then you're putting it into a retirement bucket, which then grows tax-free. And then when you withdraw from it, it's tax-free because you paid on the at the start of the process as opposed to the back end when you're withdrawing from it. And then there's other programs like 403Bs and stuff like that with colleges and things like that, but most of them are still going to be treated the same as the 401k, whereas the Roth is the only one that's post-tax.
Got it. So John, do you see sort of a particular strategy for how people roll like with their 401ks and IRAs and things for people coming back to Australia?
Yeah, and it depends on, as Brad alluded to, that there can be advantages of waiting till you come home and working under the treaty and pulling money out. Likely to still be a tax outcome from that, but there can be ways of mitigating that using superannuation contributions. But I'd say most of the time, if it's a larger 401k, if we're talking sort of 500k plus, often the taxes implications of that are going to be pretty harsh, and it's going to be pretty hard for you to cash that in coming back to Australia. And in all honesty, it's bubbling away, as I say, completely tax-free. So, that's still a good outcome, and you can be strategic. And when you draw that down, when your employment income or other taxable sources in Australia are quite low. So certainly, but the other consideration is if it's a really small 401k and you just want to simplify your affairs, quite often people will just cash them in and just kind of be done with it. And then, potentially just add it to your Australian retirement pool.
Yep, got it. Now, Brad, I know this was touched on, I think, by all three of you at one point, but I just want to make sure we focus on it because we're talking about contributing to a retirement pool in Australia. If you are living in the US, should you be contributing to your Australian super while you're in the US? And I'll ask Jason the same question because I can make sure I get both of your input on this one.
No, it's a fantastic question and probably the most common question I think me and Jason and John will get answered, I think. Look, I would say no. And because I think the US tax treatment is so punitive, it sort of defeats the benefit of putting money into your Australian super. I think if you can wait till you come back to Australia once you've left the US tax system, it's far more tax effective. First off, there's no US issues to worry about if you're not a US citizen or green card holder. And secondly, you can utilize that 5-year catch-up of super. And that's a really important tool to utilize that because your annual concessional cap is $30,000 you can put in pre-tax. If you don't use that over the 5-year period, to say while you're in America for that 5-year period, you can do a bring forward contribution for the whole amount. And that can offset your employment income and at the same time get money into your super once you're back in Australia.
Awesome. Jason, same.
Yeah, I mean, look, Brad has nailed it. Like, I tell clients not to contribute while in the US because of the detrimental effects that it can have over here. So you're helping one side but hurting the other side. So I just advise people not to do it while they're in the US tax system. Got it.
Love it. I like when we're all on the same page. John, I wanted to ask then about, so we talked about retirement. What about inheritance? Because I know there's always some questions and it's like the $10,000 question and the gifts and, not receiving too much from people, and inheritance comes into that a lot. Can you explain how each different country and sort of strategies for handling inheritance that might be coming towards you?
Yeah, quite a complex one. But looking at Aussies that are inheriting, whilst living in the US and inheritance in Australia, then I guess from a pure financial planning consideration, it's really looking at the tax and depending on the asset class, you've got to be a bit careful on how the tax is going to be treated. Former primary residence of the deceased, Brad will probably touch on, but that's something to be a little bit wary of in terms of the timing of any sale and considerations around that. But then it comes down to, once you've received the inheritance itself, it comes down to the currency exchange matter again. So, if you are planning to come home and the ultimate use of that money is going to be back in Australia, it probably wouldn't make too much sense for you to be sending that money to the US and then having to send it back again. But if your long-term plan is that US is going to be home forever, then your life is going to be in US dollars. Picking an appropriate time in the currency exchange to send it over to the US would probably make sense in that sense.
Yeah, got it. And Brad, from a tax perspective?
Yes, I mean, for now, Australia does not have inheritance tax, which is quite nice. Hopefully that doesn't change. But I mean, having said that, to John's point, there's some very important implications, which we see, with inheriting Australian property living in the US. So, as a general rule, if you do inherit Australian property as an expat, it's a little more prohibitive than what you would face if you were in Australia. So, to John's point, you normally have a period of 2 years. You can sell the deceased former home in a tax-free manner, even as an expat living in America. But there certainly could be some pretty adverse implications if you decide to hold the property long-term and live in America. So I think just get some advice around that because it's quite a complex sort of arrangement.
Yeah, got it. Brad, do you want to explain, I want to give you the chance as well, sort of Murphy tax, is this the kind of stuff that you really get into the weeds with your clients? Is this what people sort of come to you and say, like, but prior to having something arise, or is it that they something happens and they want to come to you and ask the questions?
Yeah, that's right, Josh. Yeah, we specialize in expat taxes. So we're solely focused on Australian international taxes. We look after expats, not just in America, but all around the world, UK, New Zealand, Singapore. We do planning advice for expats around the world, do Australian tax returns as well. We've got a team of 15 based in Melbourne and Sydney. But this is our real bread and butter, working with firms like John and Jason to give integrated US and Australian tax advice and financial planning advice. I think there's real benefit in having a team around you, someone that you can talk to cover off the US and Aussie side, and John as well on the financial planning side.
Yeah, no, this is great. And I again appreciate all three of you for coming on and offering your expertise, because there's obviously a lot of different moving pieces and it depends on individual circumstances, but there are some really decent amounts of advice that we can give. So from Jason, from someone living in the US, if I want to move back to Australia, are there things that I should be starting to think about in advance? Are there some strategies that I can put into place or some considerations maybe in a previous tax year that I should be putting into motion?
Yeah, I mean, timing is everything. So if you know when you're going to move back to Australia, you already have your decision point as to, well, what do I want to pull out while I'm still in the US tax system and out of the Australian tax system? Because for most Australians, as soon as you land on that tarmac, you're back in the Australian tax system. So, so it's just, that is the first thing. And then on the US side as well, planning, your exit from the US tax system and, things like 401ks and Roths, like how do you want to withdraw from it? Do you want to take it all out now? Do you want to wait for a future year where you've got low income? Do you want to stagger it? And that's kind of where it's tax planning, but then, also financial planning. And that's where John would be perfect.
Yeah, John. So, from your perspective, like if someone is planning on moving back, what is the sort of strategy that people should start to think about when they're sort of starting to optimize things?
Yeah, so I think it is really just thinking about your own personal goals. It's going to be different for every circumstance, but ultimately, if you can map out exactly what your goals are going to be, as much as possible, the time frame for the move. I completely appreciate with working with enough expats that's sometimes difficult, and if and when you're going to move home. But for those that can plan it, it makes a world of difference because, to Jason's point, the timing is imperative with all of this. So if you know when you're going to move and you know what you're going to achieve when you come home and what your ultimate goals are going to be, it makes it much easier to navigate. One, just what assets to build, then looking at navigating the currency exchange and taxes ultimately. So mapping out exactly what the endpoint, what you want that to be, will go a long way to getting you to what financial moves you should be making and when you should make those moves.
Yeah. And Brad, from a sort of capital gains perspective and from a tax perspective, what should people be thinking about if they started to build some wealth and they're living in the US and they do want to sort of forecast their plan to move back to Australia? What should they be keeping in mind and what should they be putting on the radar?
Yeah, so I mean, as mentioned before, there can be definitely some favorable tax outcomes from a capital gains perspective if you've got US assets and you come back to Australia, given that cost-based rebasing we spoke about before. But I think certainly for Aussies going to America, that's where it's a little more complex, I think, in the there's no rebasing that applies going into the US tax system, and there is a potential exit tax to manage when leaving Australia. Now, that can normally be deferred under the tax treaty with America in that if you're an Aussie, you move to America and you sell any assets from the US, you'd normally just be subject to American tax, which is normally a pretty good outcome. I mean, where it can get a bit funny, I think to Jason's point before, it's obviously quite common for Aussies to hold investments in a family trust. And that's where it can get quite messy for sure. You've got a private business or shares held in a trust, certainly get some advice before the move. I think the other... Oh, sorry, John.
No, I was just going to ask for longer term, like for the people that might want to stay longer term, is that something that you work, even if they're an Australian wanting to live abroad, that's something you can still work with them about?
Yeah, most definitely. Yeah, for sure. Yep. So, yep. And then I guess there's all sorts of outcomes you can get, with this potential exit tax that you may or may not pay when you leave Australia. There can be some upshot to paying that exit tax if the gain is actually quite low when you leave Australia. Effectively, you can get a good outcome normally when you come back to Australia. So for long-term expats looking to spend, 10, 15, 20 years in America or elsewhere, there's normally some pretty good tax benefits that may be achieved if they plan before they move and leave Australia.
Yeah, perfect.
Sure. Yeah.
Now, Jason, Uptrend Advisory is all about sort of tax in the US, and so you obviously help a lot of Australians. And so is your role sort of specifically around, like, it's basically tax time now, people come to you and they can get help filing their taxes, like you can file their taxes for them? Is that Uptrend's sort of core business?
So it's kind of like the other side of the coin to Brad. So my firm specializes in helping Australians living in the US navigate the cross-border requirements on their US tax returns. And then we also provide US advice and Australian advice with Brad, and that's kind of our bread and butter as well. In terms of, are we still taking people on right now at the 11th hour? Not without an extension in place.
Yeah, got it. So yeah, don't call Jason for this year, but for next year, yeah. And you've certainly got lots on your website and stuff as well for people who want to follow up about filing their taxes if they're living abroad. John, in terms of next steps, because people are going to have watched this, they're going to think, first off, and I just want to make sure that everyone heard at the beginning, we talked about this is being recorded, so we will absolutely make sure we get a recording out to everyone. But what should people be doing? Like, if right now I'm like, okay, like I do want to move back in the next couple of years, I'm thinking about it. What should they do? What's the first step they can take after watching tonight?
Yeah, so if you are moving back in the next couple of years, it is thinking through, I guess the tax outcomes and what your eventual goal is going to be. So, some moves that you could be making are, if you're sitting on, a pool of cash or certain assets that aren't going to be taxed by sale in the US, potentially a bond portfolio, something like that. But, the ultimate use for that money is going to be back in Australia. Right now, the currency exchange, we don't know, we don't have a crystal ball of what it's going to look like in 5-10 years, but just judging by historical standards, it is looking quite good right now. And, many of you will remember 15 years ago where it was, it was dollar for dollar. That would be a horrible outcome if you had to move. But potentially thinking about, okay, I want to get home, the assets that you can move without, a big tax implication. There's consideration on moving that if Australia is going to be the permanent home for you. So thinking through that. And ultimately, then it just depends on your personal circumstances. Those that are looking for a property shorter term and see, the forever house and want to buy that, there typically isn't too much of an issue doing that a little bit earlier. If you need to do that, but ideally that the timing is imperative with these things. So it's just lining things up and just mapping out exactly what you want to achieve. So and ultimately setting out a strategy for that, which is gonna vary depending on the individual and what their goals are. Ultimately, which is
it's always the way. That's
it is. Yeah.
And Brad, do you have any are there any traps for young players? That's one that I know that we always get the question of, like, what do people normally stuff up? What do people get wrong? Is there anything that you generally see that you think people should be aware of?
Yeah, another great question. I think we haven't really covered this one as yet, is the employment income side. So especially in this post-COVID remote working environment, that does catch people off guard, I think, in a big way if it's not planned out accordingly. Just say, you're on US payroll and you come and work in Australia, in terms of who gets a tax credit and when, and the timing around that. Because once you come to Australia and start working, you're effectively in the net from the date when you move here. And unfortunately, Australia is a brutally high tax country, right? It's a bit of a shock for some US clients that come to Australia, and vice versa. Aussies going to America on Australian payroll. They've got AU pay-as-you-go withholding being applied. US would tax that first. We need to get the money back from the ATO. So there's ways you can obviously structure around that through consultant arrangements, through having employers switching off withholding taxes and FICA and super payments. But that's probably the biggest thing I see actually in practice that's not done that well by advisors and clients that's not planning in advance.
Yeah, it's a good one. Jason, anything that you see in particular before we wrap up this evening?
Yeah, I mean, like, to Brad's point, there's similar things on the other side as well. But one of the things, this is ironic, in the US tax system as an expat, it's not even about tax minimization, it's about tax compliance. And just the IRS has a lot of international forms that have core requirements. And if those things aren't met, then the IRS does have severe penalties. So it's almost, one is compliance, and then two is tax minimization, if you're lucky, in this sense. But yeah.
No, love it. I know we've flown through an hour and we've got some questions that we won't have time for, but I'm sure I'll get John and Brad and Jason that information, and we'll make sure we send out some information afterwards so that you can connect with John, Brad and Jason. So John Versace from Apps Wealth Management, thank you very much for joining us this evening. Brad Murphy from Murphy Tax, I want to thank you very much. And Jason Stoch from Uptrend Advisory. Hopefully everyone, I know we've sort of flown through this at 30,000 feet and there's so much more we can jump into about each of these categories. And I'm sure I can persuade John and Brad and Jason to do another one of these, because I think we're going to get some follow-up questions to get right into the weeds of each of these topics. So I hope we've answered a lot of the questions that have come through tonight. I hope we've tapped into helping people decide on what their next steps are going to be. And I want to thank our panelists again very much for joining us. And yeah, have a lovely night, everyone. Thank you.